Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's episode, we're joined by Joe Brady. Joe is a globally renowned commercial real estate strategist with over 30 years of experience. Today, Joe and I are going to talk about his time being the head of real estate divisions for large corporations, as well as the managing director at JLL for over a decade. Joe's also going to share his insights on where retail, industrial, and office space is and where it could be heading. We also covered Joe's book, Work Shop, which is linked in the show notes, and I highly recommend you check out. Now let's welcome Joe Brady. All right, Joe Brady joining the Westside Investors Network podcast. Joe, I'm super excited to have you on today.
Thanks, Trent. Good to be on the West Side.
Yeah.
Yeah.
And I guess you're calling in from the East Side, right?
I am. Yeah, I've got the other ocean.
Yeah.
I'm in the Jacksonville, Florida area in Ponte Vedra Beach, which is home to the PGA Tour for those golf fans around, and we've had 15 inches of rain, if you can believe it, in the last week. So something's happening.
I'm in Oregon, and we haven't even come close to that. We will,
Right.
but not this time of year.
Yeah, exactly.
Well, before we dive in, just to let the audience know, Joe and I are going to talk about his career. Obviously, it's very vast and has tons of different insights that we're going to hear today. And one thing that we want to focus on is Joe's expertise around commercial real estate. Joe, how long have you been doing it now?
About 35 years.
Yeah, so you've seen a couple things in your career, and I'm excited to hear some of those insights. So before we get too crazy, where did your career start, and what have you focused on throughout your career?
Yeah, Trent, I came out of business school, UNC Chapel Hill, and went to work at First Chicago, which was later acquired by JP Morgan. So I really went into real estate corporate finance. And in 1990, that was an interesting time. Resolution Trust Corporation, we were definitely going through a trough, a cycle in the industry. So I got to see an awful lot of workouts happening. I got to look at and study a lot of deals that went south and understand why they went south. But I very quickly pivoted to the retail side of things and worked with a number of different retailers leading up through. In fact, you're in Oregon. Well, I worked for Hollywood Video, which is a company that doesn't exist anymore, but was based in Wilsonville, and spent a lot of time actually in the Portland market. But joined that company when it was at 100 stores and helped grow the chain in about 4.5 years to 2,000 stores. So really had a taste of the high volume rollout. And so we were doing deals literally every corner of the country. I mean, I even went to Minot, North Dakota in January. So I don't advise that, by the way.
And how did you get into working with the retail space out of corporate real estate finance?
Yeah, I wound up working before Hollywood. I actually worked for Burger King Corporation and was managing all the real estate in the Midwest, and took a hard left turn and became a franchisee. So I was a multi-unit Burger King franchisee as a kind of a 20-something, with a partner. And, I think as a young person, it's really important to learn what you don't want to do as much as what you do want to do. And so after about the seventh double Whopper with cheese thrown at my head, I decided I was better at buying land, building buildings, kitting the whole thing out. And when it came time to turn the lock and open it to the public the first time, I'm out. So I left operations at that point.
Fair
And
enough.
really wanted to focus on real estate, and that's when I actually hooked up with Hollywood Video. We had that really extraordinary rollout, and by about 2000, the home video business was starting to sputter, and I had some partners that I worked with at Hollywood Video that in around 2000 we started an outsourced retail real estate company. So we figured, hey, we just opened 2,000 of these things all around the country. We had brokers in every single market we had great relationships, and we really knew how to do this. So we decided to take our show on the road. And it's helpful to be smart. It's better to be hardworking. It's even better to be lucky. And so one of our first clients was through a relationship at Hollywood Video, but with a company that was called Voice Stream Wireless out of Atlanta. And 6 months into our engagement, they were acquired by Deutsche Telekom to become T-Mobile USA. So we wound up opening another almost 2,000 T-Mobile stores around the country, in addition to Starbucks and Texas Roadhouse and a handful of other food and beverage clients. And so we ultimately sold that business in 2008 to JLL and really created the retail platform at JLL at that time. So it was good timing, particularly since we closed, again, being lucky. January 3rd, 2008, we closed with JLL. So it was really a good time to get out of being an entrepreneur and having a big corporate umbrella to get us through the global financial crisis.
And when you were operating that business, working in that business, what was your day to day, or what were you doing for these companies on the kind of show on the road side that you were talking about?
The retailers need predictive analytics and revenue forecasting. They need a whole host of details and data. And we had a whole team that could provide that. And so we could build revenue forecasting models based on a company's underlying business. And it's vital to be able to say, you can pay this rent because we think you're going to produce this level of revenue. And our hit rate was good. So it really allowed us to be differentiated. So on one hand, we were helping with the strategy and the planning up front. And then we took that into the next phase, which was site selection, deal negotiation, and then oversight through construction until opening. So really, the full life cycle of a deal.
So you were able to do what you enjoyed and what you were good at all the way through until operations.
Exactly. Yes.
Perfect.
No flying hamburgers. And so I was at JLL for 9 years, and that allowed me, it was kind of fun because with the previous company, which was called the Standard Group, we had the lower 48, and we were doing deals literally in every corner. Once we went to JLL, it became this global platform. So again, in your neighborhood, Nike was one of our clients, and we were working to we opened 16 stores in Brazil before both the Olympics and the World Cup. And so it was kind of fun orchestrating that, wound up rolling Nike out throughout Southeast Asia. And with JLL, it was great. Although I covered the Americas, I had colleagues that were able to take care of a lot of the business in Asia. So it was kind of cool to have, an even bigger sandbox to play in. And I wound up doing some other things with banking clients and leading the banking industry group, which was really interesting because clients like Goldman and JP Morgan and HSBC were going through pretty big changes during that time. So it was, one of the challenges with JP Morgan came during Brexit, or even pre-Brexit, because JP Morgan had something like 25,000 employees in the UK. And when they saw this looming Brexit thing happen, they purposely said, okay, JLL, you need to go out and find us homes for these people because we have to go to Frankfurt, we have to go to Dublin, we have to go to Warsaw. And so again, just really interesting challenges to tackle.
And how does, I guess, I mean, you already talked about JLL being a more global scale compared to what you were doing prior. Were there any major differences aside from the, I guess, the size of what you were doing compared to what when you were operating your own shop?
Yes, and I think it was the size and legitimacy to actually play on a global basis or to even engage in the United States with some of the really big multinationals. So there was a tendency to go to the big two, JLL or CBRE. I think companies have found, particularly when it comes to outsourcing and brokerage, that you tend to go with the best team in a particular market. But when it comes to running an account globally, it's really tough to compete if you're just a small regional player. So yeah, we were able to get access to bigger clients.
And obviously, you're talking a lot about opening brick and mortar shops every corner. Everyone knows that in the last, 10, 15 years, things have kind of migrated away from that in some capacity, even more in the last 3 or 4 years. What are your thoughts on going from all these brick and mortars, 2,000 locations for all these different companies, to the online virtual world? And we hear all over the news all the time, all the square footage that's vacant in downtown, urban cores. What are your thoughts on this topic?
Yeah, Trent, it's a really important topic. In the last 10 years, there's been 100 million square feet of retail space taken out of the supply side of the equation. And why is that? Well, it's a combination of functionally and technologically obsolete retailers who became irrelevant, and the subsequent malls that were supporting those retailers. So you think about a B or a C mall. Many of those have been either reconstituted into corporate, office campuses, or a combination of flexible office space with gyms and apartments. You've seen all sorts of adaptive reuse happening. You've also seen the likes of the Sears and the J.C. Penney's and some of these other bigger boxes that have just gone dark and again have been reconstituted into something else. So we're seeing a lot of creative destruction of space. In other words, it's getting recycled. But net, there's been a 100 million square foot reduction on the supply side. Now, from my perspective, what we've seen is this dramatic acceleration of technology. And you think about, it hasn't even been 20 years since the iPhones come out, right? 2007. The power that smartphone technology has given the consumer has been astounding. So now what we see is omnichannel retail or e-commerce. Oftentimes that sort of element of online is referred to as e-commerce. What we've seen is a steady increase in the percentage in usage, and we definitely saw it spike during the pandemic. It got up to almost 20% of retail sales. Now, retail sales in the US are $3 trillion a year. It's now settling in at 15 or 16%, which again equates to 400, almost $500 billion in revenue happening online. Now, there's another element that's really important to note, and I sit on the board of ICSC, which is the trade group for retail real estate. And ICSC has done some research called the Halo report, and we're now up to our third iteration. But in every iteration, we've taken credit card data from MasterCard and Visa. The data points are up to 25,000 data points. And what it's shown is that when a retailer opens a brick and mortar store in a trade area, the online sales go up by 6 to 8%. Conversely, if a retailer closes a brick and mortar store in a trade area, online sales go down 12 to 14%. So there's a direct relationship. The consumer is speaking and she's saying, I want agency, autonomy, and optionality in how I use your brand. So I may want to go into the store today and have something delivered to my home. I may want to sit at home and have it an order and go and pick it up in store, or I might just sit at home and have it delivered. Or if the boxes pile up at the front door and I want to bring stuff back, I want to be able to physically do that. And so we're seeing this kind of this flywheel happening in retail, and it's essential to have that balance between not only the physical presence but your online presence. And the same stories that we're hearing about office right now are just remind me that I've seen this movie before, right? It's the clickbait, like no one's ever going back to an office. There's no all work can happen at home. It was the same thing about 10 years ago. The clickbait was brick and mortar stores are dead. And that couldn't be farther from the truth. In fact, there's more CapEx going into the existing stores today than ever, because the consumer doesn't just want to come in, buy something and leave. They want to be a part of the meaning of the brand. So you think about Lululemon, you think about Nike and some of the brand stores they're opening. Think about Apple, right? Now, Apple emerged as sort of this technology company to be probably the highest per square foot revenue of any retail use out there. It's astounding. But people go to Apple because they want to be associated with the brand. They want to look and browse. They want to go and have questions answered at the Genius Bar. They want to go and study and learn through the classes that happen there. I mean, there's this whole movement that happens around it. And the successful retailers are able to harness that notion of purpose and meaning, to create better equity, brand equity with their customers.
So that's all really interesting that I didn't necessarily think about from a retail standpoint of being able to physically go. And I was thinking about it myself. I'm guilty of it, where if I'm shopping at Target, I can go to one right down the street, or I can buy something online. I was always under the assumption that for retail, everyone wants convenience now. And I guess that's not the case. Everyone shops on Amazon because it's convenient, it comes right to your house. Target, Walmart, all those companies will ship things to your house. But the return aspect too, and the brand loyalty or being a part of the brand makes perfect sense, because there's some days where I don't want to wait a day to go get something when I can see online that they have it in the store and I'm just going to go get it. So that's really interesting and something I never thought about before.
And with your Amazon orders, probably, I don't know what percentage gets returned, but you can walk down to your local Whole Foods and just drop that off, right? I mean, so there's simplicity in that flywheel of how product, there's a positive and a negative supply chain that's happening. When I was head of real estate at Walgreens, we had a reverse supply chain location in Valparaiso, Indiana. And it was literally a deep, dark hole where returns just went to. And I'm not sure whatever happened to things there, but they never emerged. They just disappeared.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more. So we were talking retail, and obviously you've shared a lot about retail. What about office? Because retail, it makes sense, right? We just covered retail, but in turn, like I hear of commercial real estate, my first thing is office space. No one's going in the office, but then you have places like Amazon, all these companies saying, we need you back in, we need you back in. But what about, downtown Portland or Seattle or wherever the people have the companies have these big office spaces? What's happening with those?
What's happening is that in parts of the central business district that is predominantly focused on office, those areas, whether it's parts of Seattle, parts of San Francisco, parts of Chicago, downtown Portland, those areas are having the biggest problem right now because the central business districts rely on just work. And we know that better business districts where people want to be have live, work, and play. They're healthy ecosystems that have a 24/7, 365 vibe going on. And you can look, and it's what's interesting is it tends to be cities that have significant suburban mass transit into those CBDs. Probably less so for Portland, but again, you have sections of Portland which are demonstrably that monoculture or that monolithic office type of component. And then you have other really cool areas like the Pearl District and whatnot, where there's a lot of action happening 24/7. That would tend to be a better business district. So what's happening? Well, during the pandemic, we saw the residential internet infrastructure held up. We saw that whole companies not only didn't blow up or didn't have, horrible cyber attacks, aside from kind of what are happening from nation states out there. We actually kept things together, didn't we? In fact, I would say a vast majority of people who worked from home would tell you they probably worked longer hours, they probably worked harder, and they were probably more effective. But there was a productivity paradox that happened between workers and the managers above them. Microsoft did a research study of 20,000 employees. And of the employees who were frontline workers, 80% said, hey, this hybrid or work from home thing is really working. I'm getting more done. I'm working harder. I'm actually working almost too hard. The managers of those people, 80% of the managers said, we don't trust what those people are doing at home. We need to have them back in the office so that I can see that they're sitting in their seat at their cubicle and therefore they're being productive. Now, both sides have to give a little, right? And I think what we've seen is, a stark reminder that, again, technology is accelerating and we're, for the most part, in this new collar economy, right? Which means technology is enabling us to do our work, whether it's doing a podcast here, we're on separate coasts, or having a sales meeting, or having any sort of marketing or creative activity. Now, clearly, all of that's much better when you're together, but it's not impossible now to have it online. So a number of things are happening around this future of work. There's a struggle between the managers, think Dilbert managers that want their people back just because, and the employees who are saying, hey, wait a minute, I'm actually getting my stuff done. And so why do we work Monday through Friday, 9 to 5? And it's almost a industrial era construct, isn't it? Right. I mean, yeah. That's why here that we went to factories, because inputs would come in, we'd stand at our station, we'd work a machine, and then there would be outputs. But again, in the keyboard economy, where stuff that we're doing can happen in an office, or there could be days where you're totally focused and you're working at home, or you're working at a coffee shop, or you're working at a flex office space. We have to have a better dialogue about what it is that the company wants to achieve as opposed to the what and why of you being physically in an office. Now, there's a lot of behavioral economics that comes into play here. Did you see the movie Moneyball or read the book, Michael Lewis?
Yeah.
Right. There's some really interesting stories about that. And I wrote about it in my book where Lewis wrote this book about baseball. And the next thing you know, he knows he's getting a review by a University of Chicago economist. So not only is he an economist from the University of Chicago, he's a Nobel laureate. And he's talking about how, Lewis is channeling the behavioral economic works of Danny Kahneman and Amos Tversky. And it was so surprising to Lewis that he had no idea what this guy was talking about, that he, in fact, started researching these two guys, Israeli psychologists that came to be in the late 50s and 60s. And he wound up writing yet another book called The Undoing Project, which is phenomenally interesting. But these guys talked an awful a lot about biases and heuristics. Like we make decisions in a different way. We think fast and slow. If I said, Trent, what's 2 + 2? Our fast brain goes, oh yeah, I know that one. But 3,242 divided by pi, like the fast brain doesn't process that. We have to really work it. So why am I talking about behavioral economics? Because it's really important, because we're talking about people now as to whether they should be in an office or not, or how they behave around retail. And there's a couple of things happening. One is this notion of loss aversion. People for 2.5 years or 3 years have had an inversion of work-life balance. It's now actually life-work balance. And if you don't have to commute an hour and a half each way, you actually might be able to see your kids in the morning, or see your partner, or maybe work out, or sleep an extra half an hour, or any of a host of other things. But when I lived in Chicago and I worked at Walgreens, it was 24 miles. It could take me 23 miles. Yes, I was exceeding the speed limit, but it also could take me 2 hours each way, right? And so it was just brutal. And so through the pandemic, people realized, hey, you know what? I probably don't hate my job. I hate my commute. So there's this element of loss aversion that's happening with people. And the other thing is a notion called reactance. In other words, if you tell somebody, if I say, Trent, you need to be in the office 5 days a week, you're going to viscerally react. Again, there's another element of loss aversion. I've lost my autonomy and agency in how I conduct my day. And people have pushed back. Now, the first time Amazon reported that you need to be in the office three days a week, you had this extraordinary Slack response. There were 20,000 people on Slack saying, not no, but hell no. And the same thing is happening now relative to this 5-day-a-week return coming up in January. But another element of a bias is this, sunk cost fallacy, right? There is an element. If you're Amazon and you own $50 billion worth of real estate, right? Not all of it's office, but they have a massive office portfolio. You're going to expect people to go back and use it. Otherwise, you have this asset that you've invested in, but no one's using it. And so there's a lot of push-pull going on there. I think there's some lessons, though, that corporate occupiers and investors and owners of office buildings could heed. And that is that people want to engage in purposeful presence, not passive attendance. People want leaders helping them curate their experience, as opposed to managers saying, come to your cubicle, sit there 40 hours a week, and therefore you're doing work. I mean, that's kind of ridiculous in and of itself, right? People are on fantasy football, or they're online shopping, or they're daydreaming, or they're doing whatever. But, and I also think there's an element of metrics. What are we measuring? Everyone talks about, oh, increased productivity. Well, if I'm working for you, Trent, and I call you up and say, hey, boss, I just sent out 100 emails. Isn't that great? I was super productive today. That none of those emails actually were sent to the right people or were the right thing to do, was that really effective for the overall company's initiative, the bottom line, moving the company forward? And so I think there's probably a need to have a greater focus on effectiveness of what people are doing as opposed to productivity. Unless you run a call center or you work in a factory, but again, in this new collar economy, the keyboard economy where we're trading in information and ideas and relationships, why are we hamstrung with an industrial era construct of having to be in an office 5 days a week, 40 hours, 40 hours a week?
Well, and you kind of touched on it already, but I think of the reason I asked this because I was up in Seattle not too long ago, and Microsoft dumped like 200,000 square feet or something in Bellevue, I want to say. And so I was curious your thoughts because from my opinion, it seems like some of these large corporations aren't going to get rid of office or their office space. They're just going to shrink it a little bit. And then to your point, Joe, maybe there's going to be more conversations of hybrid schedules and things like that. I know my mom works at Nike, and in the summertime, it's 3 days a week, Tuesday, Wednesday, Thursday, most weeks, and they have a entire week off, free of charge in the summertime and all that stuff. And so it seems like the corporations, if they want their employees to get back in the office 3 days a week, they're going to have to, like you said, compromise in some capacity, whether it's hybrid schedules or whatever it may be. But I can't imagine that office space is just going to be gone. That's not going to happen. So I was curious to hear what you had to say about the hybrid schedule and things of that nature. What are your opinions on, I guess, industrial or warehouses because of this online presence and e-commerce and everything like that? You mentioned Amazon. I know for a fact Amazon has plenty of warehouse space. And are there other companies that are going to be spending their money, investing their money on warehouses versus building new office space for their employees?
Yeah, I think that'll be that a balance, right? The distribution centers that have popped up throughout the world are humming at full capacity. The real interesting challenge is that last mile within the distribution network, that distribution node. And we've seen drugstores serve as that node. What's really interesting, and if you think about this massive platform shift we're going through in AI, that we're seeing this increased importance on data centers that need to be filled with GPUs, those graphical processing units from NVIDIA and the like, to help drive how fast AI is exploding, right? So as you were thinking about the industrial asset class, yes, we will continue to see strong performance out of distribution centers, but the data centers are really where it's at right now. And they're really expensive. It's very difficult to fill a data center with NVIDIA chips. Companies like Andreessen Horowitz, who are, a venture capital firm, are actually buying chips that they're making available to portfolio companies they're investing in, right? I mean, that's never happened before. It's kind of a cool thing that's happening.
Yeah. So basically, to summarize, retail's here to stay. Office is here to stay. I guess one more question about office space. So we have all of this vacancy, right? I mean, Portland has 1 million square feet of vacant office space. I'm sure there's bigger metropolises that have plenty more square feet that are vacant. What's going to happen with that? Do you think people start going back to those offices, or do those get repurposed into something else?
Yeah, and I think you have to look at the design of the building, the age of the building. If anything, we learned out of the pandemic, we need to be in healthy buildings, not sick buildings. And when you think about fresh air intake and fresh air turnover in buildings. Some of these older buildings were designed to turn over air maybe twice an hour, right? And we know, and they didn't have any filtration. And we know now that because of airborne viruses and such, that we want to see, every 15 minutes turn 4 times an hour, right? Not once an hour. So you've got technological obsolescence you have to deal with. You have floor plates that you have to deal with. Oftentimes, if you get larger than 15 or 20,000 square feet per floor plate, it gets really, really difficult to convert that building into residential. So the stuff that's larger than that, that's the $64,000 question right now, what to do with those buildings. There's only so much self-storage or vertical farms or brew pubs you can put in some of these obsolete buildings. In New York City, 75% of the office stock was built before the IBM mainframe, which that was 60 years ago. So you have, and the same thing that happened in retail is happening in office, which is B and C class assets are losing value and are becoming somewhat obsolete. And there will have to be, again, as I talked about, that creative destruction. Will people come back? Of course they will. And I often say that hybrid work and omnichannel retail or e-commerce are two sides of the same coin, and it's all driven by the consumer. And so, leaders who want people to come back will need to nudge them back and think about ways where it's worth the commute to come in. We've heard this term that on-site is the new off-site. So making sure that you're getting people together. If you want that collaboration to happen, have everyone together. Maybe there's a guest speaker. Maybe there's, a social hour. Maybe there's a host of other things. Maybe there's a all hands meeting and senior management's able to share some information. So, I don't think you have to be in an office 5 days a week to develop culture. I will tell you what will erode culture very quickly is if you mandate people back. And so this whole notion of culture and collaboration that you're trying to foster through this mandate absolutely just undermines the initiative because of the reactance of people. You're hiring adults and then you're treating them like children. It's not going to end well.
Yeah, and coming from someone who works predominantly at home, I come to the office because this is where all the equipment is for these, but I can do everything from my house or going and visiting the different assets that we manage. And so when I hear someone say, "Oh, I have to be in the office," no, you don't. As long as you can, as long as you have a job that allows for that. But to your point, Joe, is if someone were to tell me I need to be here 5 days a week for 8 hours each day, I would tell them, no, I'm not going to do that. So it's going to come down. It'll be interesting to see how these companies and these corporations handle that and what comes of it. Again, Nike, I think, does a great job building that culture. Everyone that lives around here wants to work at Nike because they have great benefits, and summertime you get half day Fridays and a whole wellness week during August or whenever it is. Those are the things that I think a lot of corporations are going to have to look at and say, hey, how do we entice our employees and that want to come into the office, come to the HQ and be productive here? Because I think it's easy to tell that someone could be productive from their house as long as they're self-driven enough to make that happen.
And and from an office perspective, you could think about the hub and spoke model, right, where you have the HQ, and then you can have spokes either in a city or in a region. And now with flexible office space, we have the opportunity to set up locations and test and see how people use that space. Are they going to it? And if they're not going to it, then drop it. But if you have a ton of people going there and congregating, then you have evidence that suggests, well, maybe I should do a 5-year lease. Part of the problem with the office asset class is that our businesses are changing at a frequency of weeks, months, and quarters, right? With technology changing, you don't know what your business is going to look like in 5 years. Yet if you go into a new office building, you have to sign a 10-year lease. Now, not a big deal if you're a CPA firm, consultant, or an attorney. But if you're a tech company, you don't know how much space you're going to need in 2 years, let alone 10. And so, there has to be ways to test and set up space. There has to be ways for teams then to come together and maybe work for a month or two. And so it's really interesting now to have this whole nother layer of flexible office space that can be accessed by the hour, the day, week, and a series of months as well.
Absolutely. All right, Joe, I know I see your book behind you. Can you give us a quick, what's the title and a quick synopsis of the book?
Sure.
That way people can go check it out.
Sure. It's called Work Shop, and it's about the consumer-driven transformation of commercial real estate. Yeah, I talk an awful lot about the history of work, the history of technology, how that's changed consumer behavior, and the lessons that we've learned in retail and what could be applied to the world of work. Workshop is a play on the fact that 20 years ago, shop was literally a noun. It was a physical place. We had to go to a shop to spend our money. And then very quickly with technology, it became a verb, right? So we now shop. We shop online or we shop in a store. And I maintain that work is going through that same thing. Before the pandemic, Trent, you and I, if we said, hey, we're going to work, that meant we're going to an office typically, right? For the most part. Since the pandemic, those two have been decoupled. So work has gone from a noun, a physical place, now to a thing that we do irrespective of place. And so thus the play on Workshop. And so your listeners can check it out on Amazon. You can go to my website, joebrady.ai. There's a link to Amazon and Barnes & Noble and other places to buy the book. But it's been really fun to do. It's been fun to put my thoughts out there, and been getting some really interesting feedback.
Very nice. We'll make sure that gets linked. And is there any other place that you would like for people to connect with you aside from joebrady.ai?
Yeah, if you go to that, joebrady.ai, my LinkedIn is there. You can connect there. And then there's all my contact information, so you can reach out.
Awesome.
That would be the best landing place.
Well, thank you for sharing all of your insights about the different asset classes that we covered today, and where we might be headed in the future with retail, industrial, as well as office space. Thank you, Joe.
Thank you, Trent. Great being with you.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on Win, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again, and enjoy your day.